So, are you maybe tired of all that hype around short-term trading? The stuff that promises quick riches?
Mm-hmm.
And maybe you feel like you're just looking for something solid, a real path to growing wealth over time. Well, if that sounds like you, then you're definitely in the right place today.
Yeah, absolutely. Because this deep dive, we're really focusing on how to design a trading strategy that actually lasts.
Right.
We're digging into insights from a piece called Designing a Robust Trading Strategy for Long-Term Wealth Growth, which comes from the trading desk at Faida Ventures Ltd.
Okay.
And our mission really is to pull out those key principles for you. We want to help you build a more structured, sustainable way to trade that aims for long-term success, not just those quick, fleeting wins.
Okay, so cutting through the noise, I like it.
Mm.
So first up, the source really emphasizes something maybe a bit foundational, getting super clear on your own financial objectives.
Yeah.
It's not just, I want to make money, is it? It seems like you need to go deeper than that.
Exactly. You got to think of it like setting your destination before you even glance at a map.
Makes sense.
Are you trying to get some extra income each month? Or is it more about, really growing your capital over the years?
Yes.
What kind of annual return feels realistic for you?
Good.
And maybe most importantly, what level of potential loss, like a percentage drop in your money, can you actually tolerate?
Tolerate without freaking out and changing everything.
Precisely. Tolerate without abandoning ship. Because
Yeah.
your personal answers to these questions, they really dictate the right kind of strategy for you.
Yeah, that stops you from just jumping on someone else's bandwagon,
Yeah.
which might be totally wrong for your own risk comfort level or your long-term goals.
Exactly. So once you've got that destination clear, the next absolute must-have for a robust strategy is focusing on risk management.
Right.
The Fate of Ventures piece is really clear on this. A strong strategy is good risk control. They basically go hand in hand.
Okay, so how do we actually do that? The source mentions using a fixed percentage risk per trade, like say 1 or 2% of your account. Why is that specific approach so important?
Well, the impact there is really mathematical. When you consistently risk only a small slice of your capital, you drastically cut the odds of one of those really catastrophic losses.
The kind that takes forever to climb back from.
Exactly, because losses compound negatively, right? Lose 50%, you need a 100% gain just to break even.
Ouch.
So keeping losses small means they're much easier to recover from, and it lets your strategy actually work over the long run. It gives it breathing room.
That really puts it into perspective. It's about protecting your base capital.
Mm-hmm.
The article also talks about maximum drawdown thresholds.
Mm-hmm.
What's the thinking behind having that kind of emergency stop?
Yeah, think of that as your safety net, your circuit breaker. You decide beforehand, okay, if my account drops by, say, 20%, I'm going to step back. Reevaluate, maybe pause trading altogether for a bit.
Yeah.
This stops a bad run or a sudden market shift from taking out a huge chunk of your capital. It ensures you live to trade another day, basically.
Okay, got it.
Yeah.
And then there's diversification. We hear that a lot in investing generally. But how does it apply specifically when you're building a trading strategy? Is it different?
It's a similar principle, just applied differently. In trading, diversification could mean trading different types of assets, things that don't always move together.
Like currencies and commodities, maybe?
Exactly. Or you could use different kinds of strategies. Maybe one strategy works well when the market's trending strongly up or down, and another one is designed for when prices are just bouncing around in a range.
Ah, okay. Different tools for different conditions.
Precisely. Even trading the same thing but on different time frames, like daily charts versus hourly charts, can add some diversification. It's all about reducing the hit if one part of your approach goes through a rough patch.
And the Fate of Ventures article mentions their automated systems actually have this stuff built in. Equity monitoring, drawdown protection.
Yeah, and that's a great practical example. It shows how you can take these risk ideas and actually, automate them.
Makes them harder to ignore in the heat of the moment.
Exactly. You can program systems to automatically cut back on trade size or even stop trading if those preset limits are hit. It takes some of the emotion out of those critical decisions.
Okay, so objectives are clear. Risk is front and center. What's the next big piece for building this robust strategy? The source talks a lot about testing.
Yes, testing is absolutely vital. This is where you see if your idea actually holds water in the real world, or at least in simulated real worlds.
Right.
The article breaks it down into essentially 3 stages.
Yeah.
Back testing first, then forward testing, and then finally, trading with real money, maybe starting small.
Okay, let's take those one by one. Back testing, that's using old market data to see how the strategy would have done in the past. What's the value there?
The value is getting a statistical baseline. You can see historically things like potential profitability, how deep the drawdowns might have been, how often they occurred.
Gives you some numbers to work with.
Exactly. Some sense of its historical performance. But, and this is a big but, past performance is not a guarantee for the future. Markets change.
Which leads us nicely into forward testing then. How does that help bridge the gap?
Forward testing moves your strategy into the current market, but usually without risking significant capital yet. So you might use a demo account with fake money.
Or a micro account with tiny amounts.
Right, and you see how it performs with live price feeds, actual order fills, dealing with real-time conditions. It often highlights things that back testing, looking backward, just can't capture, like how fast things move or execution issues.
And the article warns about overfitting. That sounds dangerous, like you're making it too perfect for the past.
That's exactly what it is. It's a major trap. Imagine tuning a strategy so precisely that it looks absolutely amazing on one specific chunk of historical data.
Like curve fitting it.
Yeah, precisely. The problem is it's often so specific to that past data that it falls apart as soon as market conditions change even slightly. A truly robust strategy needs to be, well, robust. It should perform reasonably well across different types of markets, not just one perfect historical scenario.
So it sounds like the goal isn't some mythical, perfect strategy that never loses. It's more about building a solid, repeatable process that gives you an edge over time.
You've hit the nail on the head. Long-term success, as the article really drives home, isn't about finding magic bullets. It's about consistently applying a process.
A process with clear rules.
Clear rules, yes. Rules for getting in, getting out, managing the trade. This helps minimize those emotional decisions, the gut feelings that can really derail you.
Okay.
And a good process also has ways to review and improve built right into it.
The source mentions automation too, using expert advisors or EAs. Can you briefly explain what those are for someone listening who might not know?
Sure. EAs are basically software, little programs you can plug into your trading platform. You code your strategy rules into the EA, and it can then execute the trades automatically based on those rules.
Takes the button pushing away.
Takes the button pushing away, ensures discipline, runs 24/7 if needed. But, and this is important, it doesn't remove the need for human oversight. You still need to monitor it, see how it's doing, make strategic adjustments.
Right, which brings us neatly to the final key point. Regular review and optimization. It's not something you just set up once and walk away from.
Absolutely not. Markets are dynamic, they change constantly. What worked brilliantly last year might need tweaking this year.
So what does that review process look like?
It means regularly. The article mentions Faida Ventures does quarterly audits, for example, looking at your results. Are you meeting the objectives you set way back at the beginning?
Checking back against those initial goals.
Exactly. And then looking at the strategy itself. Based on how the market's behaving now, do any parameters need adjusting? Are there new indicators or data sources you should maybe consider incorporating? It's an ongoing refinement process.
Okay, this has been really insightful. So if you're listening and thinking about building a trading approach for the long haul, let's just quickly recap those core ideas from the Faida Ventures Ltd article.
Yeah, let's boil it down. First, get absolutely clear on your personal financial goal and risk tolerance. That's your foundation. Second, make risk management central. Use things like fixed percentage risk per trade. Set those maximum drawdown limits. Protect your capital.
Crucial.
Third, test. Back testing for historical perspective, forward testing for live conditions. Make sure it works reasonably well in different market types. Avoid overfitting.
Right.
Fourth, focus on a consistent rule-based process, not chasing perfection. Minimize emotional interference. Automation can help here with oversight.
Got it.
And finally, fifth, commit to regular review and optimization. Markets change, your strategy needs to adapt.
And really, all of this points towards building something sustainable, doesn't it? Growing wealth steadily, like building with bricks, instead of trying to win the lottery overnight.
That's the essence of it. It's a structured journey. So maybe a good question for you, the listener, to reflect on is, which of these principles do you need to focus on most right now?
Yeah, good point.
Is it getting clearer on your goals, really locking down your risk rules, or maybe it's about building that disciplined process? Thinking about that could be your next step.
And if you do want to explore these ideas further, the source we drew from, Faida Ventures Ltd, they share weekly insights on this kind of stuff, strategy design, portfolio growth on their YouTube channel. You can find it at youtube.com/Faida Ventures.
And just a necessary reminder, this conversation is purely for educational purposes. Faida Ventures Ltd isn't a regulated financial entity. Seriously, before making any investment or trading decisions, please talk to a qualified, licensed financial advisor. It's really important.
Absolutely. But the big takeaway, we hope, is that building wealth through trading over the long term isn't just luck. It really comes down to having a well thought out, adaptable strategy, building it one smart step at a time.